Hello guys, my name is CryptoKeep, and today I want us to discuss leverage, trading with leverage. This is a lesson requested by Dr. Dewumi, so I want us to discuss this. And if you haven't watched the risk management video and you are watching this, I will suggest that you watch that very video first before you proceed to watching this, because you may not understand some things if you haven't watched that risk management video. So let's get down to the business. It is said that people do use high leverage because they get liquidated very fast, whereas some people use low leverage and still get liquidated. So we will be looking into how to calculate liquidation price, which is the most important price now you want to know when trading with leverage. How to calculate the liquidation for both isolated and cross margin. And then we will see if really leverage does matter, or no matter the leverage you use, if you can manage your risk very well, if you'll be okay. So on Binance, you have leverage of up to, from 1s up to 100s, and this depends on the coin you are trading. So some coins have up to maybe 25s max, some 50s, some 75s, while Bitcoin, I believe it has 100s. If you are trading with leverage, what leverage should you use? First, you should understand that leverage is using borrowed funds to trade. Leverage is using borrowed funds to trade. So this means if you have an amount of, let's say, $1,000, but your balance on your account, let's say, is $1,000, and you want to use a leverage of 1s. It basically means you are borrowing nothing. Multiply the amount you have with the amount of leverage 1s. So your 1,000 balance will still be 1,000. So whenever you use 1s, it's basically like spot trading, with the difference of paying funding and interest. So, but when you use 2s, what this means is, and probably if you are going only with the $1,000, then your 1,000 will be multiplied by 2. So you can trade up to a position size of 2,000. And if you are doing 100x, maximum amount you can do, that will be multiplied by 100. And how much should that give you? That will give you 100,000. This means if you have $1,000 at hand or in your account, and you are trading with a leverage of 100s, which is 100 times of what you have, then you'll be trading with a position size of $100,000. This means 99,000 of the position size is borrowed. 99,000 of your position size is borrowed. And like I said in my last video, the lender never loses. Somebody is giving you this money to trade. If you make a profit on the 100,000 that you are trading with, then you keep all the profits and you return the 99,000 back to the lender with some interest on it, definitely. But those interests, they are not noticeable. If you trade with 100,000 and then you make a profit, maybe a 10% move on the 100,000 you are trading with, and you make a 10% move, that means you are taking a profit of $10,000. You are keeping all these $10,000 to yourself, right? But what happens if the market goes against you up to 10% as well? that definitely means you are losing $10,000. If you can make a $10,000 profits with a 10% move, definitely with a 10% move against you, you will definitely lose the same amount, which is $10,000. But then look at this. Your account balance is now up to $10,000 and the lender never lose. Their money is always intact. So how is it possible that when you are trading with a balance of 10,000 margined up to 100 days, $100,000 position size, and the market goes against you up to 10%? How can you lose $10,000 that you do not have? The fact is, you do not lose $10,000. But what will happen is you will lose your entire balance of $1,000. And when the market goes against you to a certain percentage in which this $1,000 is being lost, you will be liquidated. But before then, when you are losing an amount of up to 800 or around 900, you may get a margin call for you to add more funds to your account or face liquidation. Now, how do we calculate our liquidation? We will take some examples if we are using 5S, 10S, 20S, and 100S. Examples of we will take 5S, the most common one, 10S, 25S, let's say 25 then, 100S. I will do this on this same scenario. Let's take an example here on the chart so we get a point stop. Let me use this very box here. This is not a real example, it's just illustrations. Let's assume we are taking our entry at this very highs of this red candle. I know it's not red, but I'm using blue and orange, but default settings should be red and green. So this is our entry. This upper line is our entry line, while this low line is our stop loss line. But then you do not want, because all this zone is an entry zone, you do not want to place your stop just right there. So let's move our stop a bit down. Let me target stop. It's written there. So this line is our stop loss. That means you can buy here, you can buy here, you can buy here. But let's just be buying here and setting our stop loss here. Let's say we have 4 guys. Guy 1, guy 2, guy 3, guy 4. The first guy wants to trade with 5S. The second guy wants to trade with 10S. The third guy 25S and the fourth guy 100S. They all have the same amount of $1,000. If all these 4 guys are risking, if they choose to risk $50, this risk is not the position size. It is the risk if the trade goes against you to the stop loss price line, if you get taken out of the trade. So how do you calculate your position size? Like I said in the risk reward class, I showed you how to calculate it. I also have a special calculator I use. So let me use my Excel calculator here. They all have $1,000 balance, right? The first guy is using 5S, right? The second one is using 10. The third one is using 25, and the fourth is using 100x. Now, to calculate position size, what is the percentage of your entry to your stop loss? Let's do that. That is 5.33% from entry to stop. So if the trade goes against you up to a 5.33 negative percentage, you'll be taken out of the market. And by then, you will be losing $50. Here is 5%, the risk. Distance to stop is 5.33. Okay, this is not really important right now. The profit line is not really important, but let's just put it on 3R, which means if this is 1R to lose, then the 3R, let's do that. Okay, this is 3R, this is 5R. So what is the distance from entry? This is another tool you can use, but I have my own customized Fibonacci tool. And this is 3R. It's even showing a 3.02. Not that accurate, but it's okay. 3.02R. So, what is the percentage? 16.13 to profit. Okay, they have the same balance, the same risk tolerance, which is 5% of their balance, the same distance to stop, the same profit target. As you can see here, they are risking, the same amount, which is 50, 50, 50, 50. So if the trade goes against all of them, they are losing $50, right? Okay. So from a calculator, the position size for the first guy will be 938.000 something. But as you can also see, all of them, they have the same amount of position size. No matter the leverage they have the same amount of position size. So what is the difference here? The difference is a margin. Now look, the first guy using 5S has a margin of $187, $187.6. Whereas the second guy has a margin of just $93 or 94 approximately. The third guy has a $38 margin, while the last guy using the 100x has a margin of just $9. What does this mean? This means the guy with the 100x using a margin of $9 will have a tighter liquidation. His liquidation will be very close to the entry price, which means if his liquidation is very close, his liquidation may even be before the price reaches his stop loss. He may get taken out before his stop loss, and once he gets liquidated, he will lose $9. But we have to calculate the liquidation price, right? In an isolated form. How do we calculate it? The position size is $938. So now we have our entry, we have our exit, which is a stop loss, and we have our other exit, which is a take profit. Now, the position size we want to take, this is the amount of coin you'll be buying in dollar worth. So whatever trade you are taking, this is the amount you are putting in. You see, it's close to your balance, but based on your leverage, it's like you are trading $938 divided by 5. That will be your margin, right? Let's do it. 938 divided by 5. As you can see, it's similar to the first guy here. To the guy one, his margin is 187.6, and here we have 187.6. Now the guy using 10s is position size divided by the leverage he's using, which is just 93, and here we have 93.8. The same thing. Now the third guy, as you can see, is the same thing with my calculator divided by, which is $9. Now this is a position size. Let me write down the leverage, the margin, because it's needed in isolated margin. These are their margins. This is the amounts. It's like something like collateral, the amount they stand to lose in case of liquidation. So how do you calculate your liquidation price in an isolated environment? Whereas isolated means you are not using your entire balance. If you get liquidated, this is the amount you will be losing. If you are liquidated in any event, this is the amount they will be losing. But if they get taken out on stop loss, that means they will lose $50, which is the amount they have raised. So let's calculate the liquidation price for these 4 guys on this example. The cash is, this is the amount you can lose on liquidation in isolated margin, right? How many percentage of this move from your entry will go down to make you lose this amount on a balance, on a position size of $938? You are buying $938 worth here. So if you are in at this trade on 198 and the trade moves with that 938 up to this extent and you are losing $50, how much more will it go down for you to lose $188? Because that is your liquidation price. It's mathematics. So we will do the simple math of the margin amount, which is 188, divided by the position size. That is my own simple way. Binance may have their own different way, but this is the simplest form you can calculate liquidation price. Then multiplied by 100. That means if this price moves against Mr. A up to 20%, it's percentage you are calculating, up to 20%, he will lose the entire margin, which is 188. Now, let's do for the second guy. The second guy has a margin of 94 divided by the position size 938, 10%. So if the second guy, if this trade moves against him up to an amount of 10%, negative 10%, right? He will be liquidated of his margin, which is the $94. Now let's do for this other guys. The third guy has a margin of $38, right? Divided by his position size 938. That means if this third guy, if this trade moves against him on a 4% move, he will lose his entire margin, just negative 4%. Now let's do for the last guy. This guy has $10, right? $10 divided by his position size, 1.06%. Let me just take it as 1%, right? So if this trade goes against this last guy up to 1% move, he will lose his entire margin. Now let's see where their liquidation price is. We draw from here, from this top, the entry. Okay, this is 20%. That is 51 points. Okay, here. Let me mark it and say guy 1 liquidation. Okay, guy 1 liquidation. Now let's check the liquidation price for the second guy. That will be from here up to a 10%, right? So this will be guy 2 liquidation price line. Now, where is the third guy? Just minus 4%, right? Are you seeing something already? 3.99 is also 4%. Let's do like that. Are you seeing something already? This is guy 3 liquidation price. Then the fourth guy, just 1%. Let me change this to gray. As I say, entry. Just 1% from. Let me just 1.08 is the same thing, right? Are you seeing something already? Are you noticing something? Let me make this big. Are you noticing something? This is a fourth guy's liquidation, 1% from his entry, and this is his stop loss. This is where he's placing his stop loss. But then he has calculated this risk that from this point, the entry, to this stop loss, he wants to lose $50, right? Yes, he has gotten his position size. Now his position size is close to the amount he has as his balance. But then he went to buy the coin and he is using 100x, which means his liquidation price is way above his stop loss. Which means if he buys this coin and sets stop loss at this point, it will definitely be liquidated before the price will even get to a stop loss zone. Same for the third guy using 25x. His liquidation price is just a bit above. What's the distance difference here? Just 1.38% difference from his stop loss. If he is not using high leverage on isolated margin, right? If the price gets to this spot, he will lose $50. But because he is heavily leveraged on 25x, his liquidation is very tight, and once the price gets to liquidation before the stop loss, he will be liquidated, and then he will lose $38. But the second guy using 10s, you can see his liquidation here. His liquidation is way below his stop loss, which means if he enters at this price and he gets here to his stop loss, he will lose $50. But then if he didn't use stop loss and he's hoping the coin will reverse or the trade will reverse in his favor upward, and the coin goes up to a 10% move against him, he will be liquidated and lose his $94. Let's check the move from here to his stop loss, 5.38, right? Now let's check his stop loss to his liquidation. You can see it's almost another 5% move, which means it's doubled the amount, he can put a stop loss right here and recalculate his position size, but his position size will be way lesser than the 938. And this first guy who is using 5S on an isolated margin, you see his stop loss is very far. He has no chance of liquidation if he is using stop loss. Even if he doesn't use stop loss, he can still choose to sell when the coins or the trade goes against him up to this extent without him having the fear of being liquidated of his $188. He is putting more margin, more of his money to get this amount with a low leverage. But this guy is using just $10 to borrow $938. You see the difference? It's like going to a bank and giving them $10 to collect $1,000. You know, in no time, they can even tell you the next day, if you don't bring their money, your collateral is gone and your other thing is gone. So it requires a very short move to take you out when you are heavily leveraged. Guys, let this be the part 1 of this video, and let me take a small break and then we continue with the part 2. Thank you for being with us so far.